price round may be called a Series Seed, but that's what I'm talking about for this. So first of all, you should plan for a longer time frame when you're raising a priced round. So when you're raising a safe, and I'm not sure how many people here have raised safes, but you will likely raise an angel or pre-seed round prior to your priced round. The benefits of a safe round is if you're not ready to do a full-blown raise yet, but you want to grab some cash from investors to really ramp up your business. Another benefit to doing a safe financing is the documentation is really simple. You have one safe. Usually it's the YC form. You can literally download it from their website, plug in some terms, and send it off to an investor. So it's very straightforward. Investors don't do a ton of diligence prior to investing in a safe round. They may want to see maybe if you have current financials, the company's charter, and a cap table, just to make sure they're actually investing in a real company. And so additionally, you can raise over time. So in a safe financing, you can close one safe and then over the next few months, close additional safes, and there's no real time pressure. In a traditional priced round, everything is more complex and more comprehensive. If you're raising a traditional Series A, there will be 5 financing documents that your lawyers and the investors' lawyers will negotiate based off the term sheet. And the diligence process is much more robust. The investor and their lawyers will want to do both business side diligence. So they're going to be looking through all your financials. If the company has a CFO, the CFO from the company will become very close with the business folks from the fund and just really combing through all of the company's records. On the legal side, the investors and lawyers will be going through all of your documents to make sure everything's in order. And additionally, some things that founders don't really think about while they're going into a round is, you need to spend time fundraising before you actually even get to the term sheet stage. So the whole process could take 6 months. You spend 4 months fundraising, you get a term sheet, and you think, okay, it's great, it's over now. Well, no, it'll probably be another 4 to 6 weeks before you actually get money in the bank. So when you're trying to figure out your fundraising timeline and process, you'll want to think about that in terms of your runway and when you'll need that money. On the legal side, things that you can do to prepare to make the process go smoother is really familiarizing yourself with the different terms and what's important to you going into the round so that you can fight for those specific terms. And then get your documents in order. It's the least sexy part of fundraising is making sure you have, everyone signed inventions assignment agreement and all the stock's been properly issued. But it's things that really can delay a financing. And in a lot of the deals I work on, we do most of the negotiation at the term sheet stage. And so when it comes time to papering the documents, it's really easy. And there's not a ton involved. But then we have to wait 2 more weeks for the fund and the lawyers to finish up their business and legal diligence processes. So the more you can do on the front end to set that up, if you have a COO or working with your law firm, say, hey, we're going to raise and we're starting the fundraising process. Let's make sure we have all of our ducks in a row so that we can just supplement it over the next couple months. So that definitely makes the process go a little smoother. So moving on to the business side of things. So before you even get to the part of making a legal data room, you want to make sure you're making the right connections. Our CEO, Justin, recommends spreading a wide net when you are doing the fundraising process, just for a couple of reasons. number one, it helps you practice, opens the door to practice your pitch more, and getting feedback from investors that you can continuously iterate on and update your pitch. And it gives yourself options. So if you really want to raise with a specific fund, you have your top tier fund in mind, maybe save them for last, because the first time you do your pitch probably won't be the best pitch that you give. Practice on other founder friends, practice on video, watch yourself, see what you look like. I remember when I was younger, my mom used to videotape me before I had college interviews, and I thought it was crazy. But then watching myself, I touched my hair all the time. I was doing all these weird things with my hands that I'm doing right now, but you can't see me. But it really, being able to watch yourself, you're your biggest critic. You can see what you look like in these pitch meetings. And it's really about evolving your pitch, because Justin tells a story about when MessageBird was raising. The product was great, but no one understood what he was talking about, or he was really, really into the weeds and wasn't telling a story. So your pitch should be telling a story about what the company is and what you're trying to do, and why these investors should give you their money. It's really a persuasive argument and story that you're telling. So practicing on somebody who has no idea what your company does, they should be able to understand what your company does by the end of that practice pitch. Also, good reasons why you should cast a wide net is someone might give you a term sheet at that early stage before you have your meeting with your quote top tier firm, and you can use that as leverage if you are going. It's a huge long process to go through these pitch meetings. You send out these feeler emails trying to get someone to take a meeting with you. Then you take the first meeting, probably with someone junior at the fund. And then if they like you, they tell the partners, oh, this is interesting. I'm interested in this. And then you present at the partnership meeting, and then the partners all talk about you. And then maybe you'll get a term sheet. So that's a long process, a lot of people you have to talk to. So you should be setting up meetings all throughout this process. So then when you get the term sheet, now you have the leverage. They want you. And so you can then take that to someone else. Like, well, I have a term sheet already. So I am thinking about timing. We would need to move this process along. It's really similar to when you're interviewing for a job and having that job offer. Okay, so moving on to managing the highs and the lows. So a couple important things to think about here are, do you have enough money to go through the fundraising process and survive? If the answer is no, you should think about doing a safe round because of the timing constraints that go into raising a priced round. If you have 6 months of runway, you should start fundraising now. Just because, as I mentioned before, all the time and energy that goes into fundraising. And you can't really focus on growing your business when your time is spent going out to all of these meetings. And you want to think about how much runway you have, and then add on some extra time in the event of any unexpected delays. So next to think about is, to get the valuation you think that you deserve and that you want, it's necessary to hit certain milestones. So how much monthly revenue do you have? How many customers do you have? I don't think how large the company is really matters at the seed or A stage. But what are your key metrics? What are you hitting those metrics? And so additionally, if you've already raised some safe money and are looking to raise your A, and maybe one of your safe investors wants to lead your A, what did you do with that money that your seed investor gave you? Did you use it to get a new office and then to have a party? Or did you use it to make a key engineering hire and start to grow the team in a way that's going to be effective? Did you use it to then pitch new clients, new companies? And so that's definitely something you should be thinking about. And then another thing that's going to set you apart is having a knockout pitch. So I talked about this before: practice on friends, practice on other investors. But also you need to know your numbers and you need to know your metrics, because that's what they care about. They don't care. They obviously care about how you're going to change the world, but they want to know how much money you have and how well you're doing. So some key metrics are, customer acquisition cost, the lifetime value, churn, annual recurring revenue. These are some key metrics that you're going to be asked every single time you're in a pitch meeting. And if you don't know those, then they're going to think that you don't actually know your business. And then lastly, prepare for rejection. If you have very few companies that I work with are deciding between 5 term sheets that they got from their 5 meetings, it is very unlikely that you will be getting 100% return on your meetings. That's just the reality. And so when you're going into these meetings, you should be as positive as possible, but understand that it might not be the right fit. The odds are you'll get rejected. And so just to prepare for that will help you manage the lows and move on to your next meeting. Okay. So understanding the terms. So as we discussed earlier, one thing that you could do to set yourself up for success in a round is to understand the terms that are going into the term sheet and the term that you're agreeing to, and how they're going to affect your company going forward. So the most important thing that you should do is think about what matters to you. When you take money from a lead investor and if they join the board, that is a partner that you can't get rid of. And unless for some reason someone else buys out all of their shares. It's a classic example. Uber's board, they wanted Benchmark out and they couldn't get them off the board because they invested early, they had a board seat, and it's really hard to fire a board member. And the only way that they were removed was when SoftBank bought them out. And that was way down the line. And so you should really think about the partnership that you're creating and who that's going to be. Some other things that are important that you may not think about or know about beyond board structure. So, if you have 3 founders on the board and an investor's coming on, but they want to keep a 3-person board, who should be staying on the board? Is it important that all 3 of you stay on the board? That's what you should be negotiating and talking about before you get a term sheet and when that term sheet, because when you get that term sheet, it should be clear from your conversations what is important to you. Another common thing that comes up with founders who've been working on the company for a while are whether you'll have to reset your vesting. On the one hand, investors want to make sure that you're committed to stay with the company. You're not just going to get funding and then leave and cash out. So they may ask that you reset some of your vesting. If it's important to you that you don't want to fully reset, which isn't a really aggressive ask, but if you only want part of your shares to be revested, bring that up at the beginning if they say that. Even though a term sheet's not binding, except for the no shop and exclusivity clauses, which just means for a certain number of days, you can't, after you sign the term sheet, you can't go shop around for a new lead investor. So nothing else is binding in the term sheet, except when you agree to a term in the term sheet, it's pretty hard to get it out of your document. So if you agree in the term sheet that the post-money valuation is going to be $10 million, you will need to have a discussion with the investor if you want that to change. Same goes for board structure or any other weird red flag terms, which I'll get to. You just want to make sure that those don't make their way into the term sheet. Some other things to consider are the economic and operational controls. So what that means is economic controls, think about the way it affects the economics of the company and the economics of the worth of your shares by taking this money. So some things that are impacted are liquidation preference. One of the best parts of getting preferred stock is that there's a liquidation preference that's higher than the common stock. So if the company liquidates it or is sold, then the preferred gets paid first before the common. And so it's very typical to have a 1x liquidation preference, meaning they get back what they have put in. However, if an investor is aggressive, they may ask for 1.5x or 2x. So be wary of that. If it doesn't say anything, just assume that it's 1x. But definitely talk to an investor about that to make sure you are clear on the terms. Other economical controls are like pro rata rights. That affects how much of the round is available in your next round. So if you give all of your Series A investors or all of your safe holders have pro rata rights in the next round, that just eats away at how much you have for new investors. So for example, if 50% if 20% of your round is taken by pro rata holders, that means 20% of your new money has to go to those pro rata holders unless they waive it. So that means only of the 10 million round you are raising, 8 million is new money and 2 million is pro rata. So that's one thing to think about on who you are including in that bunch. Some operational controls, it's things that are going to impact the day-to-day. So who's on the board, what things the company can no longer do without preferred director approval or preferred stock approval. Common things would be to look out for are increasing the size of your option pool. So things that are dilutive to the preferred holders. If you increase your pool after fundraising, it's going to dilute the investors, and so they want to make sure that they consent to that, so they can keep an eye on their ownership. Some red flag terms to look out for in your term sheet. One of those is redemption. So I see sometimes in term sheets an investor will say, if after 7 years there's no exit, then the company has to redeem and buy back all the shares that I put in. And it sneaks in there, and it's not common. I think it's an aggressive ask. So you should really understand why they want that in there. Are they confident that are they not confident the company is going to have an exit or the company is going to fail? You'd want to understand what their reasoning is on that if they are requiring that term to be in there. Two other red flag items I see more often in deals from foreign investors, so a UK investor, and that is indemnification and reps and warranties that are tied to the founders. So normally when in a normal deal, so normal Silicon Valley deal, a company will indemnify its officers and directors. If they get sued and they're acting on behalf of the company, then the company will indemnify and defend them. that's the beauty of a corporation, is that you aren't going to be personally liable for the actions that you take on behalf of the corporation. But in these UK deals, they say that no, the founders are actually going to indemnify us if something happens, and they're going to provide that indemnification. And so if you see anything in the term sheet related to founder indemnification, you should remove that. And if they push for it, ask why. If they say it's common and they're a UK investor, assure them that it's not common in Silicon Valley. One other thing about founder reps are representations and warranties. So in your stock purchase agreement, the company makes a laundry list of reps about the company. So things that must be true about the company unless you disclose against them. So for example, litigation, the company makes a rep that there's no outstanding litigation against the company. If that is true, if the company does have outstanding litigation, you'll disclose against it. But if you forget to disclose something and the investor has a claim for a breach of the rep, they only have a claim against the company. And the company is the one making these representations. But founder reps take it one step further. They say that if the company breaches, if one of the reps is breached, then the investor can go after the founder. And the founder is actually personally making these representations. Again, not common at all in Silicon Valley deals, but if you do see that in a term sheet, that is something to put you on alert. Okay, so next, deadlines. So thing about deadlines is the investor can put deadlines on you and you can put deadlines on the investor. If you are working with a very short runway and need to close the deal, if you have the term sheet and you need to close the deal by the end of the month because you need to make payroll, that is something that needs to be communicated at the outset to your lawyers, to the investor, and to the investor's lawyers, because I mean, these deals can be done in a short time frame if everyone's working towards the common goal of doing that. So if you have any personal deadlines or a product launch, you want to announce the fundraise in connection with the product launch, any of those deadlines should be make sure they're communicated to the investor and your attorneys. Other deadlines, so you'll see in term sheets, often it says this term sheet must be signed and returned by X date, which is maybe like 2 days or 3 days from the date that's given to you. That's kind of a fake deadline in my mind. It's like a job offer. So usually if you get a job offer, it'll say accept this offer in the next couple of days. And that's because maybe they have other offers they want to get out. Same with an investor. They may have other term sheets that they want to give out, but really they just want you to accept the term sheet because they like you enough to give you a term sheet and they want to invest in you. And they've spent a lot of time, same as you, going through this process. I think if you are in the process, if you really want that investor and it's a good term sheet, then sure, go ahead, sign it. But if you are still in the process of going through meetings and are really close with somebody else, you can say, hey, I actually am expecting another term sheet this week. I'll take a look and get back to you. And then get back to them the following week. So those are kind of fake deadlines to me. Another thing to think about is investors also are fundraising. So they're also raising funds. And I have been on a few deals where we are ready to close, but the investor needs to call capital. And so be understanding, you're going through the same fundraising process. But it would be, if you have deadlines in your mind, you should be communicating those. So in the event the investor does need to do a capital call, they can plan accordingly. Okay, so moving on to timeline for communications. So like I said earlier, a lot of companies will usually raise a pre-seed or safe round prior to a priced round. And what some companies may forget about is that those people, those safe holders, all those safes are going to convert into financing. And it happens automatically, but an investor is going to want to make sure that all those safe holders have agreed to the terms of the deal that they're getting, because they're getting the same stock as the new investor. And they're going to want to see signatures to the documents from all the safe holders. And so a way to manage that is to, once you have your closing date ready to go, the documents are in pretty good shape, diligence is in good shape, you'll want to send a message out to all your safe holders. Say, hey, we're raising with this fund for this amount at this valuation. Our lawyers will be in touch with the documents. You will need to sign them. Please, have your prompt attention to this, especially as if anyone's raising right now, we're getting to Thanksgiving and Christmas. People are not paying attention to their emails at this point in time. And so if you can create that expectation early on that you'll need their signature, you'll need them to be plugged in, then you won't have the day before closing and you're missing 5 signatures. And then same with investors. I just did a deal where the investor had an oncoming board member had a trip to Africa planned, and the day we needed his signature to close, he was actually flying home from Africa. And so we didn't close. We waited till he got back for him to sign and confirm everything. And that was poor planning because we didn't know that he was going to be in Africa. So make sure you ask if anyone has travel plans, if they're going to be around for their signature. It's a really tedious process getting through closing, but it's pretty important because you need all signatures to close. So lastly, legal housekeeping, again, not a very sexy topic to talk about, but things that I mentioned in the beginning, you'll want to really make sure all your ducks in a row, cap table is in order, all your employees have offer letters and IP assignment agreements. The founders actually issued yourself stock. I have worked with companies who were at prior law firms and then came to me before to do a financing, and they don't have any stock, which creates a big problem when you have a term sheet for evaluation, because then you're not getting the stock at the low price that you'd expect to get it at. So before you start this process, make sure that the cap table and the documentation is where you'd expect and want it to be. So that's all I have for, I think. Oh, never mind. One more slide. Knowing when it's not going to happen. So this is a quote from Steve Huffman. He participates in our Atrium scale events. And I thought this was a good quote that he said. A good deal will look like a good deal from the start, and a bad deal will look like a bad deal. If something weird's going on at the outset, then it's probably going to continue to be weird. If an investor is flaky, if it's taking a long time, you need to understand when you need to cut your ties and move on. If you decide that it's not going to work out and you're within the exclusivity period, ask the investor to terminate exclusivity so that you can go out to a different investor. If the investor needs to finish raising their fund, but they do want to invest, ask them to put in a safe that's going to convert into the round, not at a discount, but just into Series A stock. And then are just different ways that you can manage it, but at a certain point in time, you'll want to walk away. And then do your own diligence on investors. Ask for references. They probably have invested in a company before. See who they've invested in. Talk to that founder. Were they a good partner? Did they live up to the intros that they said that they were going to make to different customers or to other investors? Are they a good partner? Are they a good board member? Are they supportive of the company? It's a two-way street. They want to find the right company to invest in, but you want to find the right partner. So you definitely can ask for references and talk to different references. But yeah, so with that said, if you aren't hearing back from an investor, then they're not interested and you should move on. Very similar to dating, but and just knowing when it's not going to happen. All right, now I am on to Q&A. So feel free to type in your questions, see some questions coming through.
Ali, that was fantastic. I enjoyed it. Lots and lots of information. For everyone's benefit, we've recorded the webinar and we'll send you the slides and the recording this week. So if you haven't taken notes, that's totally fine. We have all the details, and then in a few weeks we'll transcribe it as well. So I see a bunch of questions here. What MRR threshold do you typically see at prior to raising a Series A?
That's a great question. I'll need to go back and check through different companies that I've worked with. I don't have a threshold off the bat. It's really dependent on the industry. And so if you want to follow up and let me know what industry you're in, we can take a look at the companies we work with.
Awesome. What is the strangest reason that you've seen a deal fall apart?
Yeah, so I was working on a deal and it was an Argentinian investor, and it was during the time when there was a lot of corruption and issues with the company's currency. And so that's why the deal fell apart. So yeah, that was a strange reason. Otherwise, I guess I made it sound a little scary, but deals don't fall apart that often. It's not as common as I think maybe made it seem. It can happen, but usually if you're getting to a signed term sheet stage, the investor wants to invest and you want to use that investor. So I'm talking like worst case scenarios here. Yeah, okay. And one other common reason is if you can't fill out the round. So if you get a term sheet for, say, a $10 million round and the lead investor is going to put in 6, but they want you to fill the rest of the round before the deal moves forward and you just can't fill it, that's another reason that I have seen actually this year that happened. And so a solution to that is to lower the round size. But again, the investor is investing with the hope that you are going to fill out the round.
Sounds good. How long should you try to raise a Series A before you give up?
Yes, that's also probably personal to you. So if you feel very optimistic, if you have the runway, if you're waiting just for one key hire so that you could fill some metric or hit some milestone, you should wait it out. But again, if you are running out of cash, you should look to other options like a SAFE and I see a question in here about convertible debt. So I can speak to that as well. So convertible notes. So I'm thinking your question is converting notes into equity. If it's related to venture debt, that's kind of a separate issue. But convertible notes are very similar to SAFEs. They were very popular 5 years ago or so, but they're not as great as safes. They're very, very similar. The only differences are convertible notes accrue interest. So if someone puts in 100K and it's accruing interest over time, and someone invested in that note 2 years ago, you're just creating more shares that they're going to get because of that interest accrued. And then other key differences between convertible notes, there's more that goes into the note. Sometimes you do a broad note purchase agreement, and say the purchase agreement is for $5 million, and then you issue convertible notes for smaller amounts. All of those notes are governed under one agreement, and so if you need to amend that agreement, then you'll need likely a majority of those note holders. You could do it another way where everything's just in the note, and then that note holder is the only one that's needed to amend it. But then there are other things that come into play, like maturity. So again, if the note's been outstanding for a couple years and it's hit maturity, they have the option to convert into common stock, or maybe even you have to pay back the note. That concept does not exist in safes.
Cool. How important do you think it is to target funds that invest within your industry? For example, if you're healthcare, focusing only on healthcare investors, what are you seeing?
Yeah, I think that is a great way to secure a partner in a partnership that really understands your business. Because they're not just, I wouldn't think of its investors as just someone who's giving you a check. You should think about it as somebody who really gets your business, who really wants to help the company succeed. And so if you're a healthcare company and it's a fund that invests in healthcare companies and is healthcare focused, you're going to have that extra intel to get introductions, and they could really provide extra insight into the business. Whereas if you invest with a fund and the partner has no science background or no healthcare background, they're not going to understand maybe certain issues that the company is facing when you need their advice the most. So I would definitely target funds that do have that industry focus. And then you can talk to other companies within your industry too, if it's a good partner and if it's been a successful relationship.
Cool. This next question, I'm not sure if it's too specific or not. Maybe you have a general answer to this, but it's around VCs when they lead your seed round. How do you leverage them for the Series A? What should you expect from them, and what shouldn't you?
Okay, yeah, that's a good question. I don't think it's very common for investors who lead the seed to then lead your next round again. You'd think that they'd want to, but they have pro rata rights, which I mentioned. Those are under the bucket of major investor rights. So those are rights to pro rata rights and certain information rights going forward. And usually that threshold will pick up at least your lead investor. And so they already have a right to invest in your next round. And they'll want to make room for other investors, and it's a way for you to diversify who you're getting money from. Because again, if you're a seed investor, then say they own 15% after your Series seed round, if they're going to lead your A, they're just going to own more and more of the company and be able to assert more control. So I actually don't think it's that great to have them lead again. I certainly have worked with companies who raised with a fund in their seed, and then the A investor, they got a term sheet from them for their Series A, but they didn't end up going with them and went with a new fund in general, just because it's a way to spread out kind of the voting power.
Makes sense. take one last question, one or two last questions, and then close for the close out the webinar. But I think we touched on this before. But what is the strangest reason that you've seen a deal fall apart after a term sheet?
Yeah, so similar to it was really the story that I told earlier. That was just before the deal closed, actually. So I would never really count a deal as falling apart before the term sheet because you don't really have a deal until this term sheet signed. Yeah, so no, that was the strangest reason. I wanted to follow up on one thing from the last question about seed investor leading the A. You should loop them into conversations when you are fundraising, though, because they may work with a fund. Like some funds partner together, and they may have a good idea for more insights, and you'll need them to approve the deal. So you'll want to loop them into conversations as early as possible.
Sounds good. Awesome. Let's close it out with that. Thank you so much, Ali, and everyone. You'll receive a copy of the webinar recording in the next couple of days. Thanks, and have a wonderful rest of the day.
Great. Thank you, everyone.